Every investor that is beginning to invest into the stock market and invest in stocks should be investing in nothing other than index funds. And I say this for beginners because when you're starting up, you don't really know how stocks work, you don't know how to research stocks and so on. The easiest way to explain an ETF or an index fund is as a bag of chocolate. When Halloween comes around, you don't want to be passing around one type of candy. You don't want to be passing around nothing but yellow Laffy Taffies. I mean, even though those are the best type of Laffy Taffies. But you want to have a diverse selection. You want to have Snickers, you want to have Reese's, you want to have Kit Kats. So you buy a bag that contains all of these rather than buying them individually. And the same idea follows with index funds. You don't want to have your portfolio all Apple. Well, Apple's a great company, but if Apple goes down, you're going to lose your whole portfolio. So what you do is you invest in these index funds, which basically gives you pieces of different companies. Take the S&P 500, for example. There's an index fund like VOO, or VOO, which follows the S&P 500 and gives you pieces of every company. It gives you pieces of Microsoft, of Apple, of Amazon, of Tesla, and 495-ish more companies. So if one of those companies fail, if Amazon fails, you still have other 499 to back you up. And since you're investing in so many companies, you don't have to sit there and do your research and do your analysis on all 500 stocks. Another advantage of index funds in ETFs is since you have such a wide variety of companies, you eliminate your risk. You know, you have companies from the banking sector, the financial sector, you have companies from the tech sector, you have companies like Walmart and Johnson & Johnson from the consumer sector. All these sectors, if tech is up, one of the other ones might be down, so they balance each other out. If tech is down, you might have financials that's up. So your risk is lower with index funds. So there are a few types of holdings like this where they contain many pieces of stocks. There's ETFs, which are exchange traded funds, and there are mutual funds. And there's a few differences, but for the most part, they're pretty much the same. Mutual funds are only traded once a day at the end of closing, so it's not like you can check your Robinhood account with your mutual funds and see the price go up and down. You'll only be able to purchase these at the end of your trading day. So if I put in a mutual fund order at 2 p.m., this order is not going to execute, and I'm not going to receive those mutual funds until 4 p.m. that day. Now, on the other hand, exchange traded funds or ETFs can trade any time of the market. So you can buy these at 9:30 a.m., you can buy these at 10:27 a.m., you can buy these at 12:22 p.m. Any time of the day you can purchase these as long as the market's open, which is 9:30 to 4 p.m. Eastern time. These exchange traded funds were introduced in the 1990s and as you can see are probably much more practical for some people. Now on the other hand, we also have index funds. Index funds can either be ETFs or mutual funds. And all index funds mean is it tracks a specific indice. It can track the Nasdaq, which is QQQ or QQQM. It can track the S&P 500, which is my favorite, like SPY or VOO, or it can track the Dow Jones. Now within ETFs and mutual funds, we have two kinds of categories. We have active and passively managed holdings. Active ETFs are ETFs that are ran by a portfolio manager and make trades every day, buy stuff every day, sell stuff every day, and they basically manage your assets within that holding. Now, passive ETFs is what every beginner investor should invest in. These are the holdings like index funds where no one's really tracking them. No one's really buying, no one's really selling. They have the same holdings every single day and they just track certain companies. And these could track the indices like S&P 500, Nasdaq, and Dow Jones. One of the main differences between active and passive investments are active investments have much higher fees that can be up to 1.5%. And passive investments are as low as 0.03%. And just because something's actively managed doesn't mean that you're going to get higher returns. So be careful and do your research on which type of assets and holdings you're buying. When one sector goes up in the S&P 500 and the other goes down, these balance each other out. So let's say tech goes up and banking falls. Let's say the next month banking comes back up and tech falls. And because of this balancing nature or diversity in your portfolio, the S&P 500 on average returns 8 to 11% a year. And this data was taken over the last 50 years. So with this data, if you were to invest $200 every month just into an S&P 500 index fund for 20 years, you'll have $150,000. If you invest it for 30 years, you'll have $500,000. And if you invest it for 40 years, you'll have $1.4 million. And the longer you hold these funds, the more your money is going to grow because of the power of compound interest. And I mean, if I'm going to become a millionaire just for throwing my money in an ETF or a passively managed ETF and not have to worry about it, I mean, sign me up for that any day. And on top of that, I don't even have to do research in much of the company. I just have to trust the top 500 companies in America. Now here's the juicy part. What does Nate invest in? What do I invest in? Because you know, if I'm telling you guys that this is the right way to go, I'm going to be putting my money where my mouth is. So of course, my favorite index fund or ETF is VU, which I mentioned earlier. This ETF, you guys probably know by now, tracks the top 500 companies and returns 8 to 11% on average. With this big bull market that we've seen in the last 10 years, we've seen VU return actually 14%. So there are some periods where you see bull runs that return higher percents than that 8 to 11%, and then some bear markets where we see lower than 8%. Another great thing about this index fund is their expense ratio is only 0.03%. The next type of fund that I'm investing in is VTSAX, and this compromises about 80% of my Roth IRA and 35% of my normal brokerage account. VTSAX is basically a mutual fund, which, like I said, trades once a day and invests in every single company in the United States. So VU only tracks the top 500, and then VTSAX tracks everything in VU and everything outside of VU. So you're getting the smaller companies and the mid-sized companies that help boost those returns. Like I said, my brokerage account consists of 35% of this, but rather than VTSAX, the mutual fund, I just invest in the ETF, which is VTI, which are basically the same thing. One's just an ETF, one's a mutual fund. This has returned about 13.8% over the last 10 years and also has an expense ratio of only 0.03. The next 20% of my Roth IRA is in VTIAX, which is another mutual fund, but this is the rest of the world mutual fund. This contains every single company outside of VTSAX, so basically every single company outside of the United States. This gives you some international exposure because a lot of my funds are within the United States, so I want to make sure I'm getting a small percent of the exposure outside of the United States. You know, you capture NEO, you capture Alibaba, and so many other more companies. Over the last 10 years, this has seen a return of just under 6% and has an expense ratio of 0.11%. Yeah, I know this isn't as high as the United States index funds or mutual funds, but I do want that exposure just in case something does happen to the United States where the whole economy falls within a small brief period of time, because I mean, the economy in the United States is realistically never going to fail. The next fund that I'm investing in makes up about 25% of my total taxable brokerage account, and this is the Nasdaq 100 ETF, which is QQQ or QQQM. Triple Q and QQQM are the same fund, as they have the same holdings and the same percent of holdings, but QQQM is a newer fund that came out within the last couple years. It has a smaller expense ratio at 0.15 compared to Triple Q's expense ratio of 0.3. Being the tech nerd that I am, I think technology is going to be taking over the world as it already is, and we're only seeing more and more innovation over the next years to come with technology. So the Nasdaq or the Triple Q funds basically track the top 100 companies that aren't financial related. So you're not going to see Chase Bank in here, you're not going to see Bank of America, but you are going to see Apple, you are going to see Microsoft, you are going to see basically a lot of technology heavy companies, since those are the bigger ones within the United States. Usually the technology sector is the more rapid growing, and we do see banks slowing down with not much innovation going on, so those kind of weigh down the S&P 500, when on the other hand in the Nasdaq we don't have to deal with those companies. Over the last 10 years, we've seen the Nasdaq return 20% annually, and over the last year alone it returned 68%. And like I said, I don't expect this to happen every single year, but I do believe that this is the leading sector in the United States. Okay, so we're almost done. So the next fund that I'm invested in is IWM, or the Russell 2000 Index Fund. This tracks companies 1001 to 3000 in the United States. This gives you that mid-cap exposure that has the opportunity for growth. Over the last 10 years, IWM has returned about 12% and has an expense ratio of 0.19. Lastly is probably my only actively managed ETF, and this is ARKK or Ark Innovation. Like I said earlier, this returned 200%, but nowhere do I believe that this is going to return another 200% this year. It's currently falling, and it's falling from its all-time high, which was around 140. Now I think it's sitting around 110, but again, this is a long play investment for me. The Ark Innovation Fund invests in technology of the future, like Tesla, which we're all familiar with Square, which is online banking, with Shopify, with Spotify, with all this technology that can be groundbreaking within the next 10-20 years. So if you're in this for the long run, you can never go wrong with VU or VTI. These are so diverse that it's practically impossible for these to fail. Like I said, for VU to fail, the top 500 companies in the United States would have to fail. For VTI to fail, every single company in the United States would have to fail, which probably isn't happening. What I plan on doing is investing in these and dollar cost averaging, whether they're up or whether they're down. I'm just going to keep averaging in these every 2 weeks and watch my money grow over the long term. If you haven't already, check out my Roth IRA and my 401k video where you can find out how to grow this money tax-free. With that being said, guys, thank you so much for tuning in. I really hope you guys learned something. If you enjoyed this video, make sure to hit the like button, the subscribe button, and share with a friend who you think can benefit. And I'll see you guys in the next one.